My name is Michael Guyett, publisher of the Lead Lag Report, and joining us for the hour, Neil Irwin, chief economic correspondent at Axios, who's written a couple of books, which we'll get into here. But Neil, before we talk about markets and the Fed, introduce yourself to the audience. Who are you? How'd you get involved in being an economic correspondent to begin with? And what got you to write the two books?
Sure thing. Thanks for having me. It should be a fun conversation. So I spent my career as a newspaper writer primarily. I started at the Washington Post. I got an MBA. I covered the Federal Reserve during the financial crisis. So I started on the Fed beat in 2007, was kind of there throughout the kind of roiling period of those few years. Obviously, as it pivoted to Europe and the Eurozone crisis, I spent a lot of time in Europe. And I wrote a book about the global financial crisis called The Alchemists. It's a narrative of how the world's central bankers, Ben Bernanke, Jean-Claude Trichet, Irwin King, Mario Draghi, how they navigated the world economy through the global financial crisis. I left the Post for the New York Times in 2014, helped start The Upshot, which is a vertical focused on analytical and explanatory journalism, did a lot of economic analysis for the Times, and joined Axios at the start of this year. So I'm chief economic correspondent, where I write a daily, every weekday column called, or newsletter called Axios Macro. We just hit send on it 2 minutes ago. That's free. You can find it on axios.com and get a daily kind of lunchtime, kind of quick check-in on the most important macroeconomic news from myself and my partner, Courtney Brown. So that's what I'm doing.
I'm curious if, from your experience, anything has changed in the way journalists cover central bank actions. Do you think that because of natural language processing and things like that, that a lot of algorithms end up sort of interpreting what the Fed does as opposed to people like you, like back in the 07-08 period? Talk about how things might have changed over time.
Yeah, look, I'm sure every macro hedge fund worth its salt is doing all kinds of things where they can take the text of a statement or the minutes and kind of instantly make trading strategies and decisions automatically. I think there is, and that technology, I'm sure, has come a long way since 15 years ago. I think there is some value in what the Fed press corps does in terms of, we're reading these documents closely. We're talking to the policymakers. We're, really trying to understand what the reaction function looks like, what the policy path ahead might be. And a big part of our role is not to feed information to hedge funds and people who really trade on this information, but to help citizens be informed about what the government is doing on their behalf. And as the Fed has become a bigger and bigger part of the economy and the markets, an $8 trillion balance sheet and this major role they've played throughout these crises of the last 15 years, I think having that role and having the media really cover the Fed intensely has become a point of focus for all the major organizations.
So I think post GFC, a lot of investors, whenever they think about a coming crisis, they always use the great financial crisis as sort of the benchmark. And obviously, there are a lot of things that are very different this time around compared to the 07-08 period. But I am curious your thoughts, given how long you've tracked the Fed, what your thoughts are on their ability to navigate what seems like not an event, right, but rather a process of inflation. You can argue that the great financial crisis really was primarily the seeds up event that happened, with Lehman. But there's no real event that you can kind of point to necessarily here. So talk about how the Fed responds to periods like this, and if maybe they just don't know how to deal with something this prolonged.
Yeah, I mean they're in a jam. They're in a bad spot. Inflation was building going back to spring of 21, and some people very publicly were seeing some real inflation risk, and they just didn't see it. They made the wrong call and didn't even start talking about tapering bond purchases, QE, and lift off on rates until basically the end of 21, when inflation was already getting up toward 6, 7, 8%. So they're behind the curve. They're trying to figure out how to get not behind the curve without completely crashing the economy. And we'll see this in this. We're having a kind of cycle right now of, are they going to hike 75 basis points this month or 100? They're trying to turn that dial and find ways to turn that dial enough to slow the economy and not cause a recession. It's looking less and less likely they'll succeed. It looks more and more like this inflation is so high, so entrenched, so widespread, filtering through so many, not just one-off goods, but all kinds of sectors, that the odds that can be brought down without a pretty serious contraction is looking less and less likely. And you mentioned, I don't think 08 is a particularly good parallel for this. I think this is not a financial crisis kind of situation. This is kind of some mix of like the 2001 cycle where you had the dot-com crash, paired with, the Volcker disinflation, maybe a less extreme version of that. So if we can kind of split the difference between those, I think that might be what we're looking at.
But let's play with that a little bit, because I agree with you on that point about it being very different than '08. But there is perhaps a scenario that you can argue whereby we could be headed towards some kind of financial crisis, because when you have so much leverage in the system, it doesn't take that many butterflies flapping their wings to create a hurricane, right? And if the response by policymakers to every crash is to relever, and you can't do that now, that seems like a nasty situation for what could be an event to still come. That comes out of nowhere.
Yeah, I mean, I think that's completely plausible, and I don't disagree with any of that. I think the question is, all right, we've had real rates come up a lot so far this year. Is there a point at which either real rates or nominal rates would hit a level where the stuff that breaks in the economy isn't just venture capital companies that funded companies have to do layoffs? It's not just a crypto crash, but really gets to the point where you have systemically important companies, companies that employ large numbers of people hit bankruptcy, and then it flows through the credit system. So you have losses in leverage loans, losses in high yield debt that then kind of spiral out into a broader lack of credit availability for all types of businesses. And that's how this becomes not just a garden variety recession, but a more severe recession. If it this is kind of in the realm of, as you say, it's the kind of mystery risk hanging out there. What kind of industry or companies could that be? What might trigger it? What level of rates might trigger it? I don't know the answer to that, but I think it's not at all crazy to think of that as kind of one of the risk patterns that we have in the next couple of years.
Right. And there is one parallel, I think, to the great financial crisis, or at least the lead up to it. And it's not exactly a perfect parallel, but you could argue that there is a commonality in terms of housing affordability, right? And the way home prices have gone vertical, not just in the US, but you look at Canada, you look at Australia, you look across the globe. Yeah, it makes sense. COVID was a global phenomenon, so this move towards bigger homes was a global move. But that also results in all kinds of other dislocations, because most recessions tend to be preceded by housing weakness, because that's the asset that everybody tends to have, as opposed to owning stocks.
Yeah, and I think this home prices are going to have to adjust more than they have so far. We're in the early days of the kind of mortgage rates resetting and come to a higher level, and home prices. You see a lot of these reports from like Redfin and stuff on the share of deals falling through, share of listings cutting prices has happened, but we're in the early days of that, and I don't know where the equilibrium is for housing, but it's not where we are now, where we have March 2022 prices, but we have July 22 mortgage rates. It's not sustainable. I will add there is so like the fundamental problems in housing to me are about supply, and you do worry that Fed tightening creates a world where if that makes builders kind of have more reluctance to build, it can make the supply problems worse, even as the fundamental imbalance is the medium term of supply and demand. So I think we should all be watching housing really carefully and seeing where that might end up.
Yeah, and it kind of goes to this point that everything is very seemingly desynced, right? So stocks and bonds have cratered in terms of wealth lost this year, but housing, to your point, is still very early days, is still very elevated. So you've got this huge gap between public markets and the value of homes across the globe, right? I don't know if we've ever seen that kind of divergence that quickly, where homes stay as elevated as they are, and stocks and bonds are what took the biggest hit.
Yeah, and that just has to find a different equilibrium. I mean, the housing especially has these really long delays. So if you think about it, if I decide I want to buy a new house, it takes a while to get a realtor, get your money lined up, start going to open houses, find a place, make an offer, get it accepted, close 6 weeks after that, get your mortgage loan. And then before that transaction shows up in the home price indexes, it's like 6 weeks, 8 weeks after that. So, it's a very slow for the actual, you look at these real-time measures on transaction volume and, listings, how long they've been on the market, because the more reliable kind of price data, that sort of stuff takes longer. I just think there has to be a major adjustment in housing given where rates are, given where stocks are. I think give it time.
I want to do a thought experiment with you on this. I saw something earlier on financial media that suggested that the number of people that think we're going to have a recession next year is like at 60 some odd percent. Like there's this overwhelming belief that we're heading for a recession, even among those that are not in the financial services industry or tracking this on on a day-to-day basis. Do you think that back in '06, '07, you would have seen the same type of sentiment by the public? Where I'm going with that is I feel like social media and this constant conversation around inflation and saying the word recession so many times, because now everybody's able to look up things so quickly and because everyone gets emotionally tied to the narrative of the moment because of short termism, it seems to me that maybe it's not going to be as bad as everybody seems to believe it will be, because if it was that bad, they probably wouldn't see it coming.
Yeah, maybe. It is true that like right now, this mismatch between a quite strong job market and negative consumer sentiment, all this kind of recession. I mean, I saw one survey that like 53% of people thought we're in a recession right now, which, if you look at most of the data we look at on that, it's I'm doubtful that's the case. I will say though, I remember I wrote a story in the summer of 2008. So the recession of that cycle actually started in December of 2007. So the recession was underway, but the really severe phase of the global financial crisis didn't start until later that year. So we were in this weird moment where, the job market was kind of bumpy, unemployment was rising, the Fed was cutting rates, energy prices were really high in the summer of 2008. And I pointed out then that like the consumer sentiment numbers were falling through the floor and were terrible, while the actual economic data wasn't so bad. It was just kind of bumping along. And that seemed like a paradox. With hindsight, I'm not sure it was a paradox. With hindsight, sometimes the survey data can capture something beneath the surface of the economy that is important to pay attention to and recognize. And in that case, it was, people were losing their housing wealth. People were seeing their stock portfolios fall. People were nervous about what we would now call the global financial crisis. And that was real. And then they were unhappy about high gas prices then. And so that's where I think there are some parallels to right now. As you see these consumer sentiment and other numbers that are just like in the basement, they're terrible. I'm a little reluctant to say, oh, people are imagining it. They know their stock portfolios are down. They know gas is insanely expensive. They know that, the job market's good, but my raises aren't quite keeping up with inflation. Like, I think it's a mistake to dismiss those surveys just because people are going more on guts than kind of a careful analysis of conditions.
I do also wonder, though, and obviously you have to go a little bit deeper to see the political affiliations of those that are responding to those kind of polls. But I do wonder if there's an element of negativity just because there's a broad dissatisfaction with Biden, the Democrats. And I don't mean to get into a political discussion, but there are these polls that make it seem like the country's overwhelmingly bullish or bearish or positive or negative. And when you probably dig down into who's actually voting, it might be the other party than what's in power that's saying that.
I mean, I'd go a step further even than that, which is that some of this negative economic sentiment might be tied up in the same, just, the sense that just everything's awful, maybe it's the same reason more people are punching flight attendants on planes and there's a mental health crisis in the schools. And, this pandemic has really done a number on lots and lots of people. And you can look at the, jobs numbers and wage numbers, things like that, and say they look pretty decent. But, if you've been through this horrible last couple of years and it just feels like things aren't getting better, it's hard to, when somebody calls you up to ask you survey questions for an economic survey, it's hard to disentangle, economic stuff from just the general bad vibes.
Yeah, no, which makes total sense. Okay, now I had changed the name of the space to The Fed Put the World on Fire as a little bit of a play on words, not just because of your book, A World on Fire, but because of the Fed put, which you can argue is what kind of led to all this excessive leverage, all this money, and all this activity, which now the Fed seems to recognize in their statement that they don't really fully understand inflation. Maybe this is sort of the end result of all their activities over the last years manifesting finally in the real economy beyond supply chain disruptions. I want to hear your thoughts on how, again, putting sort of your journalist research hat on, and given that you've written books on the Fed, how much of this is the Fed's own doing over time? Right, it's very easy for everybody to blame the Fed for what's happened. The Fed never seems to want to blame itself, but how much do you think is driven by their own policies?
So I think that if you go back to before the pandemic, if you go back to 2019, their framework and their approach, was working reasonably well, right? Like they had been able to raise rates. The QE was done. They were doing QT and shrinking the balance sheet. We can debate their framework and whether they were put in place a new framework that was too tolerant of inflation or whatever. But I'm not of this school that like the Fed put and the willingness to cut rates when there's kind of shakiness in the markets and the economy was inherently always going to lead us to this place and lead us to this, very damaging moment in markets and the economy. I think the big mistakes, and I would also add, and when the pandemic happened in the spring of 2020, the idea that you have to pull out all the stops to keep the economy from collapsing and the financial system from breaking down. I mean, people have kind of forgotten how severe the financial strains were in March of 2020 and how easily that could have become something like the global financial crisis. I think the mistake was not realizing sooner that that their role was done, that they had done their job, they had flooded the system with liquidity, fiscal authorities had stepped up and were spending trillions and trillions of dollars, and that the era of needing to have ongoing QE, balance sheet expansion, and zero rates and forward guidance was over much sooner than they realized it. And I think this would still be a bumpy road now if they had done that correctly, but it would not, we probably wouldn't be in this world of 9% inflation and this kind of, imagine if some of the run up in stocks and other risk assets in the course of 2021 hadn't happened, right? We'd actually be in a better place if they had started tightening sooner and prevented some of the financial excesses of the last 18 months from ever really taking root, but they didn't do that.
And I wonder how much of that was because of the Fed falling for its own narrative and the emotion that was still being out there that this would be a prolonged, pandemic, right? That this was going to last longer in terms of the effect on society. I'm always fascinated by groupthink, right? In terms of how organizations work, and the Fed's obviously got very bright people and PhDs, but in your own analysis and looking at the Fed, I'm going to assume that they're probably just as susceptible to groupthink as any other organization.
Oh, absolutely. I mean, and it is as you say, a lot of smart people. I respect a ton of people over there, and they're very earnest, public servants and trying to do their, make their best judgments. At the same time, can be this incestuous world where, everybody kind of has their own, the models that they all use are very similar, and they're very similar to what like bank economists use, right? So people work as a researcher at the Fed and then go become an economist at JP Morgan or whatever. So, there's almost this refractive thing where the forecasting community and the Fed insiders are all using the same models, the same kind of mindset, the same sensibility, and that can create blind spots, no question.
Let's talk about the Alchemist book for a moment here, because you had done a deep dive in terms of trying to see what the interactions were between Bernanke and Mervyn King, right, and Jean-Claude Trichet. Talk about what you learned in writing that book that maybe most people are not aware of when it comes to central banks interacting with each other on a global scale. And then let's tie that into what may be happening behind the scenes today.
Yeah, so I mean, I think so Basel is the city in Switzerland, right on the French and German border. It's where the Bank for International Settlements is located. It's kind of the central bank of the central banks. They have a big building that looks like a beer can in the middle of right next to the train station in Basel. And it's really the forum where the global central bankers convene with some regularity. I think it's every couple of months, all of the major central banks send their governor or deputy governor to meet and have, they talk about their different economic situations and challenges and global kind of economic difficulties and kind of formal sessions. They have these grand dinners with luxurious food up at I believe it's on the top floor of the building. And in these sessions, in these weekends that happen, many times a year, there really is a kind of sense of companionship, of trust that tends to develop among these global central bankers. I mean, you can look at it in a more conspiratorial way as, look at these, guys who are clueless sitting around eating fancy food in Switzerland while their economies burn. And, I understand why people can view it that way. But I think it does in moments of crisis pays off in the sense that there is a sense of mutual trust. And so we've seen this, for example, the Fed has done these swap lines when global money markets have frozen up, both in the pandemic and during the Eurozone crisis and during the global financial crisis. The Fed made swap lines to make dollar liquidity available across the world. And they were willing to do that because they had this deep reservoir of kind of trust with the other central banks. And that made that helped prevent a global recession, global crisis, and repeatedly throughout this last 15 years. So and I think one thing the Fed and the ECB have a lot of shared DNA in the sense that their frameworks, their models are are not so different, for better or worse, right? Like I'm being a little agnostic on that, right? You could say that they're making the same mistakes and having the same blind spots, but there is some real open communication and trust there. And I would expect that that's playing out now. I expect that Jay Powell and Christine Lagarde and Andrew Bailey, Bank of England, are talking regularly and kind of understanding how these challenges look from different corners of the world.
Yeah, and that gets into conversation around the dollar and the euro, right? Hitting parity or even below it. Because if the idea of having an expanding dollar swap lines is to increase dollar liquidity, well, the dollar has been rising in a way that would suggest there basically is no liquidity. And yet we're not hearing, maybe that's not to say that it's not happening on the back end, but we're not hearing of kind of these behind the scenes, swap lines being opened up. I remember back in November of 2011, as the Eurozone crisis was still unfolding, there was that kind of shock move where I think 6 central banks the day before Thanksgiving basically announced some kind of shock and awe as far as dollar swap lines being open, and that kind of stopped the waterfall decline that was resuming in the stock market back then. But let's talk about the dollar swap lines in the context of currency movement today, and maybe for the audience, explain the relevance of dollar swap lines.
So one, the dollar is the global reserve currency. So there's trade in dollars and financial activity in dollars everywhere on Earth. The problem, of course, is if you're in Germany, if you're in Japan, and you have a need for dollars because your bank doesn't have dollars, right? You're a bank in somewhere outside the U.S. You have access to liquidity from your domestic central bank in whatever currency that is, and in a moment, and normally, dollar swaps or between private entities, flow like water, and there's no issue. There's plenty of dollars floating around the world. In a crisis, banks want to hoard their dollars. Counterparty risk seems too scary. They don't want to, part with their dollars, and so that can be a problem. And so the solution that came up with during the global financial crisis, it wasn't totally new. I believe they experimented with something along these lines around 9/11. Is to essentially the Fed, does a swap with the ECB for X billion dollars. The ECB then, pledges euros, and then, it's 90 days, whatever time span. And then the ECB can make those dollars available to their banks within the Eurozone, who then can lend to their customers and keep from having a kind of spiraling crisis. And then, after those 90 days, it unwinds and Fed feels like they're secure, everybody's happy. So it's just an aspect of the U.S. dollar supremacy kind of role as global reserve currency that doesn't get a lot of attention, but is a kind of interesting way the world works.
And do you think that the ECB wants the euro to be this weak relative to the U.S.? Because when you're faced with deflation, you want a weaker currency, but they've got worse inflation than we do in the States.
Yeah, they're in a real jam. The problem is their energy inflation is worse than here, but meanwhile, their kind of economic situation, labor markets are weaker. So, they have been slower to raise rates. In fact, they haven't raised rates yet. They've kind of have a plan to move forward, but have not pulled the trigger. We're about to be, we'll be after this next meeting pushing up closer to 3% on U.S. short-term rates while they're still 0 or below 0. So, look, the currency movements are kind of an artifact of that. There's no mystery. That's how currency markets work. I think the question is how much of that can the Europeans bear? Because the weak euro is feeding into their domestic inflation, and you think inflation's high in the U.S. as it is. Imagine if the dollar strengthening wasn't happening. I'm not sure where Lagarde and the ECB, what their comfort level is with the currency moves we've seen so far. I think that's a real thing to watch, and whether it gets to a point where they feel like they just have to tighten more aggressively, even into the teeth of a really difficult economic situation.
How do you think that might, when it comes to Europe, might filter through to some societal unrest? So, one of the things that was happening on May 6, 2010, which was the flash crash back then, was you had some very serious riots and protests in Greece, and you've seen in the emerging economies, these uprisings, these frustrations around the government because prices are so elevated. We know that wheat prices, for example, are one of the main catalyst for the Arab Spring, but I don't see too many people talking about the risk of societal unrest when it comes to Europe, given the way the euro itself has behaved. Talk about how you think about that as a potential crisis, right? Because nobody seems to be of the mindset that quote unquote civilized Europeans are going to start, bringing their pitchforks out.
Well, wait till nobody has heating oil and natural gas this
Right,
winter
exactly. Right.
when it gets cold. Yeah, I think that the risk of major unrest in countries where you don't normally see that in the next year or so is substantial. I think there is a difficult question of, if you're a central banker, what are you supposed to do, right? So, for example, the Fed sees a 9% inflation print, and they're like, this is terrible. We have to raise rates aggressively to bring inflation down. But when you do that, you're actually tightening global financial conditions, again, because of the dollar's kind of primacy in world finance, world trade. And so you're essentially tightening credit across the entire world economy. So you're making things worse in a lot of emerging markets in terms of credit conditions and financial conditions. At the same time, you have these emerging markets and developed markets where grain prices are through the roof, oil prices are through the roof, where there are literal shortages of food. And that's, the Fed and the ECB can't bring peace to Ukraine, can't make that situation calm down. They have to kind of set monetary policy based on what they think will achieve their goals of stable prices and maximum employment and all that. And, ultimately, when you have a negative global supply shock, there's just not a good answer for that. It's, choosing among bad answers.
Reset the room for everybody that's here for the remaining half an hour. First of all, make sure you follow Neil and check out his books on Amazon, which, again, we're going to talk a little bit more about here. Again, joining for the remaining 30 minutes, Neil Irwin, Chief Economic Correspondent at Axios, author of The Alchemist, and How to Win in a Winner-Take-All World. So let's actually kind of go with that book title for a bit, because I would argue that one of the reasons that we have this high inflation is that everything became winner-take-all. You end up having industries really being defined by just two or three mega players. And I've made this point many times that the real way to solve inflation isn't with hiking rates, it's really with competition. But it's hard to do that when you're in a world where technology results in the biggest getting bigger and everybody else having to, barely survive, right? Talk about the dynamics of this kind of winner-take-all dynamic that we're in as a society, and what were some of the things that you kind of referenced in that book?
Yeah, so the book itself was kind of a career advice book for navigating this world. But I think there are some real macroeconomic implications of the kind of winner-take-all effects in the economy. So many industries are, as you say, two or three players. And, in fact, the entire Jackson Hole conference Kansas City Fed puts on, and I believe it was 2018, was focused on this set of issues, because they really do have macroeconomic consequences. Think about in kind of asset management, right? The fact that BlackRock and Vanguard and a couple others account for such a huge proportion of asset management. Think about tech, where there's the FANG, there's four companies that seemingly control every aspect of our technological lives. So the book was about like how you kind of navigate finding a job and a career path in those types of companies. But I think that the implication for the overall economy is we're seeing the downsides of kind of supply constraints in which a more competitive market might mean more supply. And, you've heard some of this out of the White House, things like, poultry processing and farmers can raise all the chickens they want, but there's only two or three companies that process those chickens and get them to grocery stores. And so they have market power. Arguably we're seeing with refiners right now, where that's a bottleneck and part of the reason oil or gasoline is so expensive. I think you can go through industry by industry, and there's a sense that CapEx is lower and, competition is lower than would be optimal if you want to see kind of long-term growth. And I feel like industry after industry, we're seeing, the problem is really capacity bottlenecks, housing, right? So there's not enough makers of windows. So home builders can't get enough windows or can't get enough drywall to put up houses at the pace they would like. And, I think it really raises huge questions about the structure of the economy, and at what point the things that make sense about winner-take-all effects, right? When there's software, when there's, kind of economies of scale that come from information economics, and at what point do the benefits of that get outweighed by the costs of not having more vibrant competitive marketplaces for a wide range of goods and services?
Right, and that's why there's this kind of strange dynamic. I spoke about this with Michael Green over the weekend, that you can make an argument that the Fed should keep rates low, if anything, just to try to encourage some kind of competition, because the more you raise rates, the less you're going to have entrepreneurs coming out to borrow capital to try to build a business, and to, whether it's for mining, extraction, whatever it would be, the higher rates are, the harder it is for new entrants to enter, right? So there's this kind of strange dynamic where the cost of capital being used to fight inflation may actually not, maybe a short-term solution, but then you kind of go back to longer-term inflation because you haven't solved the competition problem.
I think that's a great point. Yeah, I think there's been a lot more interesting kind of discussion and analysis So like there's a group called Employ America that has done some really interesting research on supply problems in the economy. And, I think there's a recognition that there are downsides to using the Fed as our main inflation fighters. And, they're raising rates quickly. They're trying to crush demand and bring demand in line with supply. But a side effect of that is it's going to hurt the supply side of the economy. I mentioned home builders earlier, oil drillers, right? So if high yield debt rates are skyrocketing, if capital is flowing less freely, that's not going to encourage oil drillers to go out and start pumping, right? If you think about any kind of industry, looking at higher rates might say, well, now's not the time to do CapEx. Now's not the time to build capacity. I think we're heading into a recession. And if they do that collectively, in terms of the economy as a whole, then we just end up at a lower equilibrium GDP and employment and everything else a couple of years down the road. That said, nobody else in Washington, I live in Washington, nobody else in Washington seems to have any great ideas of how to address inflation, right? It's not like Congress is talking about raising taxes to try and reduce demand in the economy and get a better equilibrium, lower inflation. So the Fed is kind of the only game in town on fighting inflation, even though their policy tools have some real downsides that could leave us in a worse place in 2 or 3 years.
Okay, well, hold on. Let's go with that, because that brings with it sort of a discussion around the political response to this inflation. Because, to your point, you're not seeing anybody talk about raising taxes, and that's debatable as to whether raising taxes would break inflation, because you're going to take it away from the very wealthy, who are not the big driver from a demand perspective, right? So
or you can cut spending, just anything.
Right.
Nobody's talking about really cutting spending either. Like there's whatever your politics, nobody's really putting forward fiscal proposals that would have an obvious kind of disinflationary impact.
Right, but one thing we know for sure is that the Republicans will blame it on Democrat spending, as opposed to taking blame themselves for the trillions that Trump put into the system too, right? In terms of leveraging. But let's talk about that, because it's. I had put a poll out maybe a month and a half, 2 months ago, where I said who's to blame most for inflation, and the two choices were Biden or Powell. And the overwhelming majority said Biden, which was actually really fascinating to me. I don't think that's a tell on my audience. I think it's just sort of an interesting dynamic, because most people don't understand the role of the Fed, outside of our industry. But what is there really anything that the Biden administration can do? I mean, everyone's looking to the president for some kind of leadership here, but it's not clear that, to your point, they can really do anything anyway.
Yeah, I mean, so it's funny when I talk to people at the White House and the administration, and they really do. And Biden had an op-ed in the Wall Street Journal just a few weeks ago, basically putting the Fed front and center, saying the best thing we can do is let the Fed do its job, keep them independent, not try and jawbone them or put pressure on them. And they've stuck to that, right? You haven't heard a peep of criticism out of the Biden team about the Fed raising rates, even though they might be about to cause a recession. So, that's respectable, but that's not the same as coming up with a solution. That's saying it's these other guys' problem. And it is true, like fiscal tools are not really well suited for this. To their credit, they have done some things around like bottlenecks at ports and trying to, convene groups to work through, different problems at the ports in very specific industries. But, and they will say that some version of their Building Back Better plan, whatever form that would end up taking, is disinflationary because it helps things on the supply side of the economy and reduces the deficit. So that's kind of their case. I think the reality is, elected officials, if what needs to happen to bring inflation down is you need to crush demand. There needs to be less demand in the economy. No politician wants to do the things that would make that happen. No politician wants to raise payroll taxes or cut, social welfare spending in an election year. And so, that's why we end up with a situation where the Fed is the only game in town on this. I will contrast that with the 70s. Arthur Burns, as inflation was kind of getting out of control, the chairman of the Fed was Arthur Burns. And he essentially blamed everybody else. He blamed things that were real, oil shocks out of the Middle East and, union kind of wage demands and things like that, and didn't take ownership the way Jay Powell is and say, we're going to do what it takes to bring this inflation down. So that is a difference between now and then, but the cost might be a pretty nasty recession.
Right. And to your point, austerity is a disinflationary force, right? So to your point about cutting spending, that would, you can argue, work, but exactly to your point, especially in an election year, nobody ever wants to take spending out. If anything, they want to get voted in by promising more. I mean, it's mind-numbing to me that you've got these proposals for gas relief with gift card equivalents, right, to help the lower and middle class, when in reality that's the exact opposite of what you want. It actually keeps demand elevated by subsidizing higher prices with future liabilities.
Yeah, no, I mean, this is California is the biggest one, but some other states are doing them as well. And look, I understand the impulse, right? Working class people are hurting. Their prices are rising faster than their incomes. The things that are getting expensive most quickly are necessities. It's gasoline, it's food. So I understand the impulse to help people out and give them some cash to get through that. But in the aggregate, if the problem is constricted supply and excess demand, throwing more money into the system is going to make that problem worse, not better. If, one state can do it without being too big a deal, but if 10 states, 20 states are doing it, suddenly it just makes the Fed's job harder. It makes the inflation pressures worse.
Right, and they'll keep on scapegoating the Fed as being late while they're maybe slowing them down.
Yeah, and they are late, but the more help they get from fiscal policy, from supply chain policy, from things like that, the less they have to crank the dial. And we're already in a place where we might be in for a really rough year or two. And the less they have to crank that dial, the less rough this next year or two is going to be.
So you mentioned you're in Washington. You talked to a lot of politicians. Behind the scenes, is there a lot of sort of strategizing by Democrats around the message for the midterms? Because I think everyone seems to be of the belief that Republicans will win because inflation will rightly or wrongly be blamed on whoever's in power, right? As that inflation is taking place. Again, forgetting the nuance that this is a much bigger conversation. But what's happening kind of in Washington as far as thoughts around how to counter the narratives around inflation, aside from this idea of let the Fed do what it does? Presumably, that's still going to be a big issue for voters.
I mean, look, you hear a lot out of the Biden people emphasizing that gas prices are coming down now. They have receded a good bit over the last month. That the June inflation number that just came out, it was kind of peak gas prices, and things have been drifting down since then. If they would love for that trend to continue and to take just some of the pressure off of people's, I think gas prices especially just really weigh on people's moods. You have to fill up your car every however often. You drive by a gas station with a big sign, it really is a crusher for people's sentiment and feeling about things. Politically, so I mostly talk to kind of the wonks and the policy people and in the administration, Capitol Hill, but I get some sense of the political dimensions of things. And look, the Democrats know that this is a rough environment for them. It's always, 2 years, if you remember any of the last ex-presidents, that's, a tough cycle for the incumbent administration. They know the kind of winds are against them. It's hard to imagine Democrats keeping the House of Representatives, just, it's such a narrow margin, and, it's the sentiment is so bad. Republicans will almost certainly control the House. The Senate's a little more interesting. The Democrats do have a path to keeping the Senate. They have pretty good candidates. So like Senator Warnock from Georgia seems to be up in the polls against Herschel Walker in a purple state. So the Senate, just because of the kind of details of who's running and who the candidates are in each race, Democrats do have a pathway to keep the Senate, but it's not a good political environment for Democrats, and I don't think anybody really denies that.
Yeah, no, I think that's 100% correct. Okay, so let's go a little bit back to the Fed and kind of the internal discussions that we are not privy to, because I'm going to make the assumption that internally within the Fed, when inflation is this high and the pressure is so high, individual Fed analysts, governors, they're going to start to maybe be a little bit more careful with aligning themselves with Powell, right? Because they also don't want to get the blame. And in the event that Powell can't control this, there's going to be a vacancy at some point, presumably that they can kind of vie for his position. How do you think about unity within the Federal Reserve here? Do you think that everyone agrees that rates have to rise, but presumably it's now a question of one person maybe thinking 100 basis points versus 50 versus 200? Talk about some of that dynamic.
Yeah, I mean, it's interesting. There's always fault lines. And if anything, I would say that the final votes end up not exposing the degree of the actual fault lines in that room. I think there is kind of to dissent is considered kind of a big deal. And you don't, if you think they should, so last meeting, they did 75 basis points. If you really thought that should have been 50 or thought that should have been 100, but, not with a strong degree of confidence, you weren't going to dissent. You thought they were in the right ballpark and would probably go along with it. So, and different, so Reserve Bank presidents are more likely to dissent than governors. Governors I don't believe a governor's dissented since like 2005 or something. I guarantee you it's not because every governor has exactly agreed with every policy choice they've made. It's that there's kind of a sense of institutional unity. I think it's an interesting point you raised that as things get more difficult and more hairy, might that crack up? I think of the governors right now. So Chris Waller just gave a speech this morning. He's been a little to the hawkish side of Jay Powell. He's emerged as a really interesting, influential voice. Could he be a candidate to be, Fed chair under the next Republican president? Plausibly, he's a Trump appointee. Absolutely plausible. And does that type of thing weigh on people's minds? Who knows what goes on in anybody's mind? And governors, there's the new Biden appointees on the board of governors. So Lisa Coke just started. Phil Jefferson just started. Neither of them has given a speech yet. We can kind of guess where their economic thinking is from their confirmation hearings and their writings, but they have not gone out there yet to really stake out a claim. Might Lisa Cook emerge on the dovish side of this debate, plausibly, or maybe she'll stick with the more traditional thing of being a team player and keeping any disagreements within the House. And then there's the reserve banks that are more all over the place and less kind of under the feeling of being on the team in Washington. So you can get a more variety of opinions. Esther George is very interesting. So she's the outgoing president of the Kansas City Fed, normally a hawk. She's dissented in a hawkish direction many times over the years. And this time she dissented in a dovish direction because she thought that doing this kind of surprise 75 basis point rate increase could be too disruptive to markets. So, I think there is an interesting, we talked about groupthink earlier. There's a risk of that going on, but I think this we might see more fissures as this kind of sense of inflation crisis persists.
Right, because at the end of the day, everybody's always, there's always a degree of ambition with anybody that's in any institution, right? So, yeah, there's groupthink when things are okay, but the more that things get extreme, the public and the constituents within the Fed will, want to point to one single person and then disassociate with that person's views, right? And I think that's sort of where it might get interesting in terms of the internal dynamics of the Fed.
Yeah, I will say, look, Jay Powell is a very effective, there's a reason he had a career on Wall Street and in private equity and, has had a long career of business success. And the reason he got appointed to this job in the first place, he is, good at leading a policy process, at kind of trying to keep people on sides, listening to people. I think I believe before every FOMC meeting, he's on the phone with every member of that committee to know where people's concerns are, to try and nudge them his preferred direction, to make sure he doesn't get too far away from the center of the committee in terms of its views. He's a very savvy kind of executive type in that respect. But that said, if we keep seeing inflation numbers like we did yesterday, he is not going to be remembered as a successful Fed chairman. If he can stick the landing, that'll be different. If he can bring inflation down and the economic damage isn't too bad, then he'll be viewed in history differently than if this really goes off the rails.
Okay, so that's actually an interesting point because no one wants to have their legacy ruined, obviously, right? So I'm sure Powell feels tremendous stress and pressure, but he doesn't quite know how to your point, kind of stick the landing. Now, I put this tweet out a month and a half, 2 months ago. Bernanke, I think it was February or March of 2009, was on 60 Minutes and was asked the question along the lines of, how confident are you that you can control this in the event that inflation, really kind of skyrockets, as the Fed was embarking on all of their stimulus back then, post Lehman. And he expressed 100% confidence. And he said, the Fed can raise interest rates in 15 minutes if it has to, basically to quelch inflation. And I've used that as sort of a point to say that why is it that the Fed is not just ripping the Band-Aid off and doing a 300, 400 basis point move and just shock the system to save the system, so to speak? Why is it that you think that the Fed is being seemingly so slow? They themselves agree they're behind. So why is the reaction still seemingly not enough?
I think what they would say, this was Esther George kind of covered this in her speech the other day on why she dissented. I think there's a view that by signaling their policy path, they can get the kind of financial conditions impact almost immediately, right? So we saw the run up in pick your indicator, corporate yields, mortgage rates, treasury yields, like any measure you want to use of kind of credit availability and price of credit really started jumping up as soon as they started their hawkish pivot back in November, December of 21. And that's, even at the point in March when they did their first rate increase, 10-year yields, for example, had already moved up a lot, and they're continuing to move up. So they would say, look, by signaling our future path of action, we are achieving what we're trying to achieve in terms of financial conditions. And if you did 300 or 400 basis points at one time, that would be such a shock to the system that you create greater risk of just getting a crisis, getting kind of a scenario we discussed at the beginning of this, which is, you really cause bankruptcies, freeze up of credit availability, the kind of things that are not the constructive kind of demand destruction, but actually a kind of crisis situation in a lot of sectors of the financial system. And that, if you do if you signal what direction you're going, but then carry it out in a kind of gradual way, you maintain some optionality and lower the risk that you either break a lot of stuff that you don't intend to break, and lower the risk that and keep the optionality to adjust that path as you go and try and calibrate it more precisely, rather than just say, all right, we got to get rates higher. Let's do 300 basis points tomorrow. So I think that's the view there. There's always this question, as you suggest, of, okay, at what point is shocking the system actually desirable and something you want to do? And I think that's been kind of the open question. And right now it's a live question of, do you do 100 basis points in 2 weeks? And to be seen, I guess.
Yeah, and I guess my point in that, and I agree with what you're saying, my point, though, in that is that in order to get back to some kind of long-run average for inflation, let's call it 3%, if you want to call that mean reversion from where we are, you have to ultimately go past the mean for mean reversion to take place, right? Which means that you probably have to have almost like a period of outright deflation. And you can only really have that if you have defaults, if you have some kind of a crisis to put such an abrupt stop and yes, have bankruptcies and have that pain to bring things back in line to the long run average. I think if you don't do that, you risk an even bigger problem, which is that the mean is a lot higher. And that will be very problematic long term when incomes are not keeping up.
I mean, I think that's not a crazy view. That's certainly a reasonable way of thinking of kind of how the moving pieces fit together. I think it's not the Fed view. I think their view is it is possible, maybe not likely, but it is possible to have the economy cool down, have demand cool down in a non-recessionary, non-crisis situation. I mean, Powell used this phrase, we still think we can achieve a soft or maybe soft-ish landing. That was not the June meeting. That was the previous one, I believe. And, I think the soft-ish means, there'll be some bumps. There'll be some, some things that aren't great for people. But this doesn't have to be an all-out recession, and certainly not a deep recession to achieve that kind of moderating in demand. You might be right. They might be wrong and naive about what it takes to really keep inflation from becoming entrenched once it's been as high as it is lately.
It is interesting as you say that, because I don't recall other Fed chairs expressing a degree of wishy-washiness or a degree of doubt in their rhetoric and their narrative, right? So you mentioned soft-ish. That doesn't sound very confident, right, from Powell. And then when Powell said, we're only now just starting to understand how little we understand about inflation, that almost seems like a mea culpa that they're not that confident about how they can handle this. And I don't recall in the '08 crisis, Bernanke having words like that or narrative like that.
Yeah, I mean, part of that might be a personal style thing. I mean, I think Powell really is he's a very conversational speaker. He's not a PhD economist. He's not, the downside of that is, you can, like, I thought the comment on we were learning how much we don't know about inflation is the kind of thing that, like, economists might say to each other, but you don't normally expect the chairman of the most powerful central bank in the world to say it on the record in front of.
Right, it's not very confidence-inducing, right? Exactly.
But I think that might be partly his kind of personal style of communicating.
Yeah, I just wonder if that ends up being misinterpreted by the marketplace. Investors need the illusion of certainty, right? They need to have some kind of sense that the future will play out the way that it's being presented to them by those that can shape the future, which are the policymakers. And it just seems to me that, that maybe is conversational style, but that may end up having very unintended consequences in terms of the confidence of money in this kind of environment.
Yeah, so there's this broader kind of process that's happened over the last, century, really, but certainly accelerated over the last 20 years of central bankers going from being these mysterious kind of men behind the curtain, all powerful, all knowing. I mean, there's this famous line that, the governor of the Bank of England can raise his eyebrow to tell a bank not to do something, that they don't have to speak at all. And as central banks have become more transparent, they now announce their policy moves. They give all these speeches, all these interviews. They're out there a lot. And Powell, like, the first time, Bernanke didn't even do a press conference until I think it was 2010 or 2011. Before that, there were no press conferences. Now there's 8 a year on top of hearings, interviews, speeches, everything else. And look, I'm a reporter. I like transparency. I think it's great that we can, someone in my job can understand what they're thinking, what they're doing, but there maybe is something lost, and there maybe was something to be said for this. Alan Greenspan was famously kind of taciturn and mumbled and didn't really, speak very clearly. It was kind of the opposite. To your point, I think something may have been lost in the transition to this new, more transparent era.
Yeah, and I often I've talked about this before. I do wonder if that transparency ends up having maybe unintended consequences due to reflexivity and the idea that they provide a narrative to give the market some sense of confidence, and then if it turns out that the future they're talking about doesn't happen, now the market totally ignores any kind of future guidance that the Fed does. I do think there is something to monetary policy which is valid in terms of not being so transparent, just to surprise the market sometimes with monetary action.
Yeah, I mean, to your point, that's exactly what happened a month ago, right? They had said for weeks and weeks, all right, 50 basis points. And then one bad CPI number comes out, and a Michigan sentiment number, and New York Fed's survey of consumer expectations, a couple of like CPI plus a couple of kind of ticky tack indicators, and suddenly they're walking back the thing that they had telegraphed for months. Is that confidence instilling? Probably not.
Yeah, no, exactly. All right, so listen, everybody that's here, please make sure you follow Neil Irwin. Neil, for those that want to take a look at some of your writings and your books, obviously on Amazon for the books, but any suggestions for people tracking your reports?
Yeah, please subscribe to our newsletter, Axios Macro, AXIOS.com. Macro is the newsletter, comes out every weekday at noon from myself and Courtney Brown. It's a kind of short, quick read on all of these topics, on kind of what you need to know to understand how the economy and monetary policy are evolving.
Very good. Thank you, everybody, for joining us, and enjoy the rest of your days. Thank you, Neil.